So I'm Ben Peeler, and I'm the partner in charge of our IRS tax controversy services. It's a long title, but what it means is I help our clients deal with the IRS and IRS disputes. I'm a former IRS attorney. I was there for 8 years and helped review a lot of these international penalty issues, and I could talk about that a little later. And then, of course, my partner in presenting here is Jared Johnson. He's the principal director of global mobility services, which means all these individual international transactions and returns, he is the expert at. So he and I work together to mitigate some of these things, issues that come up with these international penalties. So today our learning objectives, I'll go over a little bit. We're just going to cover the basics. We know there's lots of different people here for different reasons and different learning objectives, but we're trying to cover all of them. We think these three do. We'll kind of discuss the basics of it, but also the pitfalls and risks, things you need to do to, align your arguments and what you need to know. So reviewing penalties, we'll go over, what the worst case scenarios can be and how to avoid them, those pitfalls. And a lot has changed in how you can submit things to the IRS and deal with any international penalty problems. So we're going to go over that. Lastly, that's the overview of the options, because everybody asks about OVDP, but it doesn't exist anymore. And we'll go over, there's always been other options, but we'll go over those. So with that, I'm going to turn it over to Jared, who's going to start off talking about each of the forms.
Thank you, Ben. Yeah, so this slide right here is kind of the crux of our conversation today. So the U.S. government has various forms that they require U.S. persons to file to disclose foreign assets, the ownership of foreign assets. And we'll kind of get into the penalties, but there are significant penalties for failure to file these forms. And that's basically the crux of why we're talking about what we're going to be talking about today. So first, we'll focus on each of these different international disclosure forms and kind of talk a little bit about what each of them are. What we're finding, the world is so much smaller than it was 20, 30 years ago. More and more people have these types of disclosures and assets, foreign assets, and therefore such disclosures. And we're starting to, as a CPA firm, we see more and more of these types of reportings every year. And the most common one out there is the FinCEN form 114, better known as the FBAR form. And this is the one that, again, everyone has, most people that have foreign assets have heard this. So basically, if you have ownership in foreign bank accounts that exceed $10,000 in aggregate, you have to disclose the existence of that form or the existence of that foreign bank account to the U.S. government. So this form captures any accounts that you have a financial interest in a foreign financial institution, and it also includes accounts which you have signature authority over in a foreign financial institution. So a common thing that a lot of people miss and don't really think about that have foreign, what is a foreign financial institution? It could be an institution that you have a foreign private pension account in. That would be an FBAR filing disclosure in many cases. Not all the time, but a lot of times. So this is, and the other thing that people miss here is that the accounts are in aggregate. So people will ask, well, I have $5,000 in this account, 5,000 in this one, 5,000 in this one. Well, if the aggregate balance of all those accounts add up to $10,000 more, you have to disclose the existence of all those accounts. Now, one thing about most of these forms is they are, for the most part, they are informational in nature. So they may or may not have a tax liability for just reporting there's not a tax for owning assets overseas. It's the tax comes when you have income from these assets. And so not only does the IRS want you to disclose the existence of these, but it's also of the utmost importance that you disclose the income earned from these assets. So the next one is that,
Jared.
yeah.
What about if they have, they have to buy freight or something in a foreign country, they have to buy it in foreign currency, so they just get a bank account over there and then they just put money in and then pay it right out. So you may or may not at the end of the year or whenever you're reporting have more money in it, but through the year had $100,000 that flowed through it.
Yeah. So typically with income reporting, you're in most situations, now there are some exceptions to this, but in most situations you report earned income, not fair market value appreciation. You would have an FBAR filing obligation because you open that account through a foreign financial institution, presumably. So in which case you'd have to disclose the existence. And then if that bank account, if it's a savings account, it earns interest, then you would need to report that interest income. Even if, and I tell all my clients this, even if that interest is earning like, this is such low hanging fruit and has so much attention with the IRS. In most cases, in the US, you don't get a 1099 if you have less than $10 of interest, right? There, which kind of leads you to think, well, the IRS doesn't really care if you report interest income of less than $10. They do, but that's the message you get when they don't require, interest income 1099s be reported for less than $10 of interest. I tell all my clients, if you have 50 cents of interest income from a foreign bank account, you should be rounding that up and reporting at least $1 of interest, because that's where they'll get you on these amnesty programs. Is like, if you fail to miss one form and you have unreported income, they're coming at you hard. The IRS is, they can. And so I wouldn't mess around with it. I just, any income you receive, I'd report it. So the other forms on here that get a lot of attention are the 8938, which is a sister form to the FBAR. The FBAR is filed to it's e-filed the U.S. Department of Treasury. I'll go over that in just a minute. The 8938, it's filed separate than your 1040 or tax returns. But the 8938 is filed with your tax returns. Mostly it's an individual form, but sometimes there are some entities that are required to file it. But it's very informational in nature. That's the same information you report on the FBAR, you report on the 8938. You have the 3520s and 3520As. This is for reporting of ownership of foreign grantor or non-grantor trusts. So not only if you're the owner, but if you are a beneficiary of them, there's these filing requirements. There's 8865 is where you report certain ownerships of foreign partnerships. 5471 is probably one next to the FBAR, and the 8938 is probably the next most common one we see, but the ownership of foreign corps. 8858s are a little less known. It's the ownership of disregarded and foreign disregarded entities. And then 8621s is like a swear word in a lot of CPA's vocabulary because it involves PFICs, and PFICs are very complicated. And this is an area that a lot of CPAs don't want to see because they're just so complex. And anyway, so these are the common forms out there. But did you have a question, Ben?
Well, I was just going to note, we see a lot of people that have, since they changed a lot of the rules for what's a PFIC, what's not, and what's when you have an interest in a foreign corporation, people have direct investments in captive insurance companies, group captive insurance companies, and they get this information back, but they don't realize they need to file 5471.
Yeah.
And also report subpart F income, right? But
yeah, and again, I said a lot of these forms are informational in nature. It used to be that 5471 was very informational at one time, and then with tax reform with President Trump, that went away. With repatriation of prior year earnings and taxation of those prior year earnings, that form, and now we have the taxation of guilty income through 5471s that that we have to calculate now. So that,
all a bigger deal now.
yeah, it's so much bigger. Yeah.
What
So
what if my dad makes me a beneficiary of a foreign trust but doesn't tell me?
see, and that's where we would want to, like, a lot of times if you're the beneficiary, you don't have, if you're a US person and it's a foreign trust that was established by your father, which happens more often than people realize, you typically don't have a filing obligation until you start receiving distributions from that trust, unless you are all of a sudden, maybe your dad passes away and now you become the owner or controller of those assets held in trust. Then you may flip from not only just being a beneficiary, but also having a filing of a non-grantor trust obligation. But you then once you become the owner and control those assets of you as a person, you then may have a foreign grantor trust filing obligation. Meaning, if that income, if you own assets in trust and you control those assets, and that those assets start driving interest income or earned income, that income starts to flow through to you on your personal US return, kind of like that 3520A that has a filing obligation basically generates almost like a K1 statement that flows through the individual. So anyway, it's generally,
Be careful
you don't
with
have a
your
lot of
CPA.
reporting as in that situation, Ben, but once you start receiving distributions, you will.
Yeah, sometimes dad will give you distributions to pay your foreign taxes and not even
Yep.
tell you about that. So.
Exactly. And that's why we're here today, is because things like that happen and people find themselves sideways with these filing requirements. And we're going to get into in just a second the penalties on them, so you can kind of see the issues. But once they get sideways with them, then that's when the wheels start turning people's heads. Well, how in the world do I come clean without incriminating myself and subjecting myself to really draconian type penalties? I just really quick, we covered a lot of this in the FBAR, or regarding the FBAR in the earlier slide, but a lot of people ask, well, when was the FBAR really created? Like, when was this filing obligation first established? And believe it or not, it's been around since the Bank Secrecy Act of 1970. Wasn't very well known, wasn't followed very closely, probably wasn't as common back then to have, for more people to have ownership in foreign bank accounts. Then in the Jobs Creation Act of 2004, they added the civil penalties for non-willful violations, and they also increased the willful penalties for willfulness. So that's when it really started to get real serious. And anyway, and we'll kind of go over those penalties in just a second, but we've already covered when it's required, with the $10,000 in aggregate. The other thing is the FBAR, it used to be where you could paper file it, but can't remember what year it was. Maybe about 5 years ago, 3 to 5 years ago, they changed the filing obligation where you have to e-file the FBAR now. And at that was the same time that the deadline for it used to be June 30th. They changed it to April 15th to line up with individual filing requirements. This is really kind of weird. A lot of people reach out to me and say, how do I extend the FBAR filing deadline? You don't. It's an automatic 6-month extension. So basically your filing deadline every year for the FBAR is October 15th. Automatically. You don't have to do anything to get that. So I don't know why the IRS just doesn't say your filing deadline is October 15th with no deadline or no extension. But they don't. They say it's April 15th with an automatic 6-month extension. So that leads us to our first polling question. Have you ever had a FBAR, a foreign bank account reporting obligation? So I'll give you guys a minute to look at that. So kind of a good mix.
Almost half and half, right?
Yeah. So like I said, the world is getting smaller, and I see more and more of this, and I get questions almost on a daily basis from people having questions about FBARs and these filing obligations and that we've talked about. So anyways, let's leave, this leads us right into Ben. Ben's going to talk to us a little bit about IRS audit procedures and these offshore assets. So I'm gonna, there we go, Ben. Oh,
One back. Well, we kind of
there
just
we go.
to
There we go.
dispel the myths and things with this, and people are always asking us. Sometimes we run into people that are, it sounds like avoidance questions, but I think people should know what goes on. I mean, when I was at the IRS, we had several types, of cases that would come to us for these international penalties. Obviously, when you get audited nowadays, it's a required question. It's a required question on your return, and they always are trying to verify that. They'll ask you they even double up on the question. Obviously, you need to be very careful when they say, "Are you sure you didn't have any foreign assets that you need to disclose?" And that's a question that comes up on just a regular exam. So that's one way. Then of course, some people are being directly audited for this reason. I was involved in several of them, one of which was a offshore credit card plan, where people would repatriate the money that they had put offshore, not report it through credit cards. And we obtained, the IRS, when I was with them, when I say we, not me anymore, but obtained all that information through sort of John Doe summons that we obtained. That means it went to the bank and just the people running the credit cards to get the names of the people that own them, and then started the investigation onshore, essentially. So that's the way that can happen. Or you go through one of the disclosure processes, and then all this is going to come up, obviously, because you realized you didn't file correctly, and you need to go fix it, and you're disclosing one way or another. That's the way they come up. So just remember, the agents have powerful tools. I love to get involved in these tools because we were basically what people didn't think. A lot of people thought, well, they won't know about this offshore account, but we could just, in most cases, summons a local branch. So an IRS summons is an administrative request for documents, and we could summons records from a local branch of a bank, even if it was there was a foreign. Sometimes we had some complications where they tried to say they weren't part of that bank, but in most cases, we could obtain, through a special kind of process of our summons, records from that foreign branch, because they had a domestic branch, and we like to use that one. Another one that was common was, the IRS, the federal government, has treaties with all these different countries, and part of that process is we're going to be nice about sharing information. So we would go to a liaison in the IRS that would usually, out there in foreign countries. Some would cover like whole parts of Asia or Europe or a different area, and we'd ask them to go obtain the records from the bank through their administrative process. So they'd go over to their revenue authority and then ask for the records and then give them to us. So people didn't often know about that. So now the regular IDR process that's my one that's the most tricky, because some people think, oh, they're just asking me about these basic things. But when they give you the long list of questions about your foreign transactions, sometimes they already know information. A lot of people don't know that most of these agents can go do a public record search on a person. And so if they have a wealthy person, they'll often just go get a public record search to see what property you own, what cars you have. And sometimes it divulges that information or transactions. We often, dealt with and a lot of our clients have fallen. I brought up that one about buying, paying for freight in a foreign country, where a corporation had that. They got flagged because they had more than $10,000. They had these reports that come through Treasury, where the banks send and say, hey, this person has these large dollar transactions going over. It was seemingly innocuous, right? Nothing going on. They didn't know they would get flagged, and it flagged this whole audit. And of course, they hadn't filed their information returns, because they thought, well, money going into a bank account and then just going out and getting paid. It's not sitting there. We don't really we only have the bank account to get currency changed. So those are some of the things they can do. It's a sort of a minefield process, and that's why we always say you got to have somebody involved that knows what they're doing, because some of these things the IRS can interpret, and we'll go over what they say is willfulness or not later. But the IRS is trying to build that case from the beginning. They get sort of they first have to go ask for the ability to go investigate a case, and I'll talk about that. But once they do, a lot of them just think you should know or you should have asked. So you always have to be careful about how they're building that case. I'll talk a little bit about the statute of limitations, a lot of misconceptions there. Most of the forms Jared talked about, they just deal with the normal statute of limitations, but people should know if there's income in these accounts and it didn't get reported, if you have a 25% omission of income, you can have a 6-year statute. Normally under 6501, it's just a 3-year statute, but it can be a 6-year statute under 6501E. Or if you have fraud, which oftentimes is in play here, because they're dabbling with just having an account in another country is sort of can be kind of an indicia of fraud. And so you have to watch out for that. And that can be an unlimited statute of limitations. Generally, most forms apply to that, but there's special rules. In 2010, they changed all the rules. And so a lot of these forms, if you didn't fill them out right, or you didn't file them, then there's an unlimited statute of limitations. And then also 6501CA extended this unlimited statute of limitations to all items on the return if they were related. But if they're unrelated, it could just be limited to those items. If there's reasonable cause, it definitely only applies to the items related to the failure to file those forms. So the FinCEN 114 or the FBAR has its own statute. So that's a 6-year statute, but there's other issues we'll talk about. And Jared, maybe you want to move on to that, but people should be warned. It's not a normal form. It's not what we call Title 26 form. It's not a normal IRS form. It's basically a treasury form. So specifically to FBARs, we'll talk a little bit about these audit procedures. So like we said, since the FBAR is in a separate it's in Title 31, which is different than Title 26, where the Internal Revenue Code is. And so it's basically to try to, it's all laws enacted to try to get people to report their assets, right? And figure out what's going on. Past years ago, so that they had this tool, because they were, offshore accounts are not new. But so in order for an agent to start asking questions about it, they do have the authority to do it, given to them by regulation, but they have to go ask permission, and it's essentially just a paperwork process for them. But occasionally they might not do it, and you can complain about it. But in this process, then you know that they're going to get serious about asking those questions. They're going to ask you about all sorts of things, bank accounts, obviously, your brokerage accounts. Like I said, sometimes people don't realize when they get into group captive insurance, that's a foreign asset a lot of times. Real estate, jewelry, art, whatever. It doesn't have to be just that bank account. They'll start asking you questions about all of it. They'll even, like I said, they'll do the public record search and see what you have that shows up there. And you'll be surprised, a lot shows up on that report. Then they have these, the text reports or the TECS reports. Those are reports, we didn't obtain them too often unless it was those sort of direct fraud cases we were working on. You're basically asking them where they were, where they traveled, what was their, shows up under their foreign traveling. And there's a report that they can obtain that explains that. They'll also ask your tax preparer. And we always worry about this because sometimes the tax preparers don't realize that they need to be careful about what they say, because a lot of times all of whether you get in trouble with the IRS hinges on if you divulged everything to them. And so they'll often ask questions especially if they find different things that may have issues, and they'll ask your preparer and to try to ruin your reasonable cause argument that we talked about. So, and one of the big points here is that a lot of people hear that, well, even if these penalties are asserted against you for FBAR, since it's a separate regime, the IRS normally has 10 years to collect on all their taxes and penalties, but not Title 31 has its own collection limitations. So they have 2 years to do it. But what we would do in the IRS is you can still reduce these liabilities to a judgment in district court, and then you have a longer period of time to collect. Additionally, they can also set off money you are owed and to collect the tax. The government can do that with any debt, and so that's something people don't realize. And that can go on for 10 years under the normal rules of the IRS. Now, of course, we are always worried about when people start answering these questions and they don't realize that if you have a little bit of knowledge and you didn't act on it, it can add to worse consequences from the IRS. So you have to be very careful about your responses because they can assume too much and they can make it into a much bigger issue. And it can even end up being a criminal investigation, which in a criminal investigation, even if it doesn't end up in a criminal action, it can make big problems for you and be very difficult. It could cause problems for your business. So the initial responses, even it's kind of a catch-22 because a lot of times the agents are like, well, you're not being forthcoming or what have you, but we're usually trying to make sure the responses are correct, even though we don't actually provide them in time. So we want to see the documents before that response comes out. So Jared, if you can move on to the next one.
So these are the penalties related to those forms we kind of talked about, and I'm not going to spend a lot of time here for sake of time, but you can kind of see, from this slide that the FBAR has a non-willful penalty of $10,000 for each non-willful failure file, and then the willful penalties go up substantially. And then you'll notice on all these forms that most of them carry with them, or a lot of them carry with them potential criminal penalties. The reason why is like Ben was saying, is they're under a different code section. And I think these code sections were used mainly to combat like financial crimes, like money laundering, support of terrorism, those sort of things. So that's where a lot of these criminal penalties and civil penalties fall under, and that's why they're so egregious. And but you can see that, for someone that doesn't know about the rules and laws and they run afoul of the rules, these are really harsh penalties they could be facing.
And what people don't realize is the IRS may interpret just the continuation of not filing as sort of a intent to evade. So you can't just keep on. Once you learn about it, they say that's a continuation of the act.
Yep.
Can make you criminal problems.
Yeah. So that's the PFIC one doesn't really have the civil penalty. What their penalty is that basically is the unlimited statute of limitations for if you should have filed an 8621, you didn't. Technically, your statute of limitations never expires. So
being a PFIC is almost your own penalty.
Yeah. So true. So this leads us to our next polling question. Can the IRS prosecute an individual with criminal charges for failure to file an FBAR? Yes or no?
So just talking about that a little bit.
Yep.
There was that Canali case where the taxpayer was figured out that they had a problem and even had an attorney involved to try to get into some sort of disclosure, but was still on the fence about what was reportable or not. And just next year told the preparer didn't have anything, didn't divulge it yet, but was about ready to divulge. And the IRS turned that into a criminal. One more return filed, not checking the box.
Yeah. So most of you did answer yes, that is the correct answer. So gotta be really careful. So All right, so now we're going to get into risk mitigation and the different options that we have under these programs. So here are the different options that we're going to kind of talk one by one. So about each one of these. First one, IRS criminal investigation, voluntary disclosure. There's this one that relief. This is kind of not very well known. It's fairly new. It's a lot newer than some of these. Well, actually, this first one, the IRS criminal investigation, this is the one that that followed the OVDP, or the Offshore Voluntary Disclosure Program, that just grandfathered out. So this is actually the newest one. This one is also fairly new. This relief for procedures for former citizens. I'll talk a little bit about these.
You just call it VDP, right?
What's that?
We just call it VDP now.
Yeah. Yep. And then the streamlines are these next three are very common. So we'll kind of talk about each one of these. So
can you go back to the slide for just a second so I can mention something? So just the slide is kind of indicative of how Jared and I do the analysis, right? Because the first thing we need to know enough facts so that we can say if you need criminal protection. And if you if they do need that, it's a totally different process. And we usually it will involve a criminal attorney to assist just to the process. And then the rest, it's kind of a sliding scale, right? Of well, where do they fit and what have you? But that's always the first question. So
yep. So let's see who can participate in these programs, and let's see. Yeah, here we go. Okay. So before we get into the specifics of each of the different programs, we'll talk basically these general requirements. So first of all, these are designed for US persons. So what is a US person? A US person is a citizen, a resident, and a resident is someone who's a US green card holder or someone who meets a substantial presence test. Next question is, well, what is a substantial presence test? That's the US's tax version of determining whether you meet residency in the US. And it's a 3-year look back rule. So basically, just really quickly, you take, if you were in the US for 31 days or more in the current year, and then using this formula, if you exceed 183 days or more, you've become a resident. So the formula is 100% of the current year days that you're trying to determine residency in, a third of your days in the US prior to that, and then 1/6 of your US days in the year before that. So if you add up the sum of that formula, again, 183 days or more, you're a resident of the US. You can get out of that using possibly tax treaties or other code sections, but in general terms, you're a US person. And once you're a US person, you're subject to all of these all these international forms that we're talking about. These amnesty programs are generally designed for individuals and for estates. However, some entities can be included in some of these. The streamline ones are most common. That's just estates and individuals. The FBARs kind of open there for anyone with an FBAR filing obligation. The voluntary disclosure program, that's for individuals, entities, you name it. So, all right, now we're going to talk about specific programs, and this is the very first one. Like Ben was saying, this is the one out there we're going to decide or help you decide and determine whether you are willful and whether or not there could be potential criminal penalties imposed by the IRS for your facts and circumstances. And basically, this program is designed to limit your criminal penalty exposure. It's a formal program. You have to get permission to enter the program. So you're basically coming in and saying, hey, I'm here, I'm kind of guilty, but I want to come clean. And used to be on this, the Offshore Voluntary Disclosure Program used to be the old version of this. You come clean. the IRS would tell you what the penalties were on that in that program. This one they won't. They're leaving it open, and when they review your facts and circumstances and during the case, it's going to get reviewed, as you'll receive a letter of closure when it's all final. But during that process of finalizing it, you're basically being audited, and they're going to assess you, that decide what those penalties are. You basically file up to 6 years worth of returns and FBARs in this program. So this is, you don't see this one very much, at least we don't. There's lots of them out there, but a lot of the people, our clients or potential clients, more non-willful facts and circumstances. Okay, I'm not going to spend a ton of time on this one because there's a lot of facts and circumstances. This is designed mainly for people who I would probably call I would call accidental US citizens. Who may have been born to a US, and I don't think a lot of people understand this. If you live outside the US, but one of your parents is a US citizen, and you're, by virtue of your parent being one of them being a citizen, you would automatically be a US citizen. A lot of that happens a lot. So a lot of US citizens live overseas, they have families, they have kids that are born to them, all the kids are US citizens automatically. So this program basically is designed, in order to relinquish your citizenship, you have to have filed 5 years worth of returns. This is designed for people who've never filed a return, was basically an accidental citizen, didn't realize it, they found out, and they want to file their 5 years worth of returns and renounce their citizenship all in one fell swoop and come clean all in one fell swoop. This is what this program is for, but it's very strict. You have to meet these thresholds. If you file under them thinking you meet these thresholds, but you really don't, the IRS doesn't, they find out that you don't meet the thresholds, like your net worth is more than $2 million and you file in this program, you can bet the IRS is going to come after you, and they're not, and to the full extent of the law. So the nice thing about this program is like, if you don't have a social security number, you don't need to get one. That means if you have balance dues with those returns, the IRS will just forgive the balance dues on the returns, and you just walk your way. You have to show that you've renounced your citizenship, and there's some court fees you have to do to do that, to show them. But this is a really good program for some people, but it's not designed for the majority. This is a very minority type population. Now we're talking about Streamline programs. There's 2 versions of this, and these are the most common that we see. These are designed for people who are willing to certify under penalties of perjury that their facts and circumstances are non-willful conduct, are due to non-willful conduct. It's a very informal process. You don't ask to be entered it, you just file, disclose. The IRS will never come back and tell you, hey, we've received your streamlined filing and you've been forgiven. They'll just, no news, basically no news is good news. So you'll see a common theme that the IRS has they are more willing to forgive and have maybe have a more kindness in their heart for people who are not residing or living in the US. Okay.
It's far less accidental.
Yep, exactly. And that's why, because they don't have the resources that someone here in the US does, of finding out what their filing obligations are, hiring qualified professionals, etc.
That being said, it's not a stated thing, but that was the 2 million threshold before, but the richer you are, the less they're inclined to believe the facts we usually put forth.
Exactly. So this program kind of shows you that sense of kindness they have for people. because this is a really good program. If you can certify that you are outside the US for more than 35 days, you can't be in the US for more than 35 days a year. So the streamlined period is a 3-year tax return process and a 6-year FBAR. So they're going to look over that 3 years and they're going to say, were you in the US more than 35 days during any of these 3 years? If you say, yeah, in 1 year, I didn't exceed 35 days, then you can qualify for this program. And the beauty of it is a lot of these programs have a price. So you have to, in lieu of those FBAR penalties or those other, you kind of have to, a lot of them, you have to pay a penalty to get out of them. It's a reduced penalty. Well, the reduced penalty for this program is 0%, which is a great deal for people. So if you can qualify for the Streamline Forum program, this is a great program. The other good thing is you would not have had to have filed prior year returns. So if you come in, you're like, I never filed a US return, I live outside the US, this is the program for you. And it's other than the cost to file and comply, there's really no cost to someone.
Yeah, and often those are the only people that align with those facts, right? Because there's the slightly more accidental, but you are hanging yourself out there. And
Yep.
that's part of the analysis, is that we need facts to make sure you really had reasonable cause or something, because it doesn't protect you against criminal
Yep.
penalties. They could go after you, and you're divulging all of this. So.
Yep. The streamlined domestic is there's a 5% penalty for this. So basically you take all your assets over that 6-year period, the year which those assets peak, foreign assets that were unreported, the year in which they peak, you take a one-time 5% penalty on it. That's how the 5% penalty works. On this program, again, you're certifying under penalties of perjury your conduct was non-willful for your failure to file. One of the issues, if you did not file a tax return in one of the 3 years, you don't qualify for the program. So if you miss one of them, these returns have to be amended returns. So, but good programs, they're a lot better than what they could be, what these penalties could be. Brings us to another polling question. What is the streamlined penalty filing under the Streamlined Forum procedures? 0%, 5%, 27.5%, or none of the above?
Yeah, and they're delicate though, because when you get these sorts of situations, we're always sorting through facts that sometimes are hard to prove. And so we're thinking about what could go in an affidavit if necessary. We don't put a lot of that in there. We're usually just writing up the facts, but a little more delicate than normal penalty.
The right answer was 0%. So almost the majority did that one, but the foreign is 0%, the domestic is 5%. So,
well, then to get into either of those good programs, right, you have to be non-willful. So what in the world is non-willful? And sometimes Jared and I wonder if that's an agent by agent definition, because you got to understand, the courts, there's some court cases out there that have made this even more precarious, but when the agents are trained, or how they interpret this has become sometimes complex. They have guidance, and it changes almost every year. The IRM almost changes every year, and you can look at those, but I don't know that they encompass every situation. It's kind of the stark ends of the spectrum, right? If you look at their examples. But what we want people to know, and we can just read the definition here, if it's non-willfulness, right, is conduct that is due to negligence, inadvertence, or mistake, or conduct that is a result of good faith understanding of the requirement of the law. So that's, where does that fit? We'll go over more of the situations we run under, but I think we're always answering two questions, right? We're trying to figure out, why didn't they know that they had to do this, right? They had to file some form or not. And what did they do with that, right? Did they, with the typical person, the IRS always thinks, well, the more sophisticated they are, more education they have, and honestly, the wealthier they are, then the more likely they should have, it's more reasonable for them to have to ask a professional, what should I have done? So we're always having to explain, well, why didn't they ask a professional sometimes? Or then it gets into what did they tell the professional, right? Because then the guidance the professional gave. We often find though, this isn't just, it's not always what happened back then that influences willfulness, but it's what you do in there in an examination or in response to the agent. So if they interpret you as not being cooperative enough, then that can go sideways. Now, of course, that wouldn't be in either of the Streamline programs because the IRS can't have already approached you about it. But willfulness covers the gambit from exams to these programs. So, but I always, as a lawyer, that's always interesting to me that there's a whole bunch on the back end that they seem to put in there. If you're not quick enough or you didn't bring it up soon, they think you were trying to hide it. So they're always looking for you to disclose the facts. That's why we are always trying to, even in sort of the in-between situations, prepare a reasonable cause argument that covers both of those questions. So the one that everybody talks about, and there's several cases following, is US versus Williams, how this changed everything. At first, everybody thought it was just an aberration, but now there's another case called Garrity and some other cases that have sort of followed this Williams here, where they said that willfulness wasn't you knowing you had an obligation and avoiding it. It was, you could just be willfully blind, and that would be enough for willfulness. And that's essentially, even though there's this out in the world, there's this vague understanding that, you make money, you're going to have to pay tax on it. You're going to have to report it somewhere. And if it's from a foreign source, the IRS believes you kind of should know that. That's going to have more complicated responses. And the more money you made, they think there's more leverage on that issue. So real quickly, just to sum it up, you can be willfully blind, as in Williams, where you just didn't look into the question enough, and you didn't ask another question when there was definitely facts showing that you should. Now, of course, reasonable reliance is the one we always focus on. Getting advice from a professional can sort of eliminate this willfulness question. Jared, if you want to move on to the next one. These are the questions that come up in all of these cases that we've kind of mentioned. Was there knowledge of reporting obligations? Those are specific. You can go into emails where you're going back and forth from your accountant, and if there was definitely an exchange, that could create a problem for you if you can't explain it away why you didn't take it further. Was there a conscious effort to avoid learning about FBAR filings? That's that willful blindness we talked about. It's out there. Maybe, sometimes nowadays the foreign investments will send you a letter, kind of a warning letter saying you may or may not have a reporting obligation. It's not saying you do, but not looking into that further can be that new willful blindness problem. What was the source of the funds held in the foreign account? Sometimes, like we talked about, your dad doesn't tell you have a bunch of money in a foreign account. That's different from a business, obviously obtaining money and keeping it in a foreign account, or your service business, something like that. But to me, the biggest thing is reporting income. Jared and I always have to deal with this first and foremost is, okay, the forms are one thing. They're complicated. Yes, you got to talk to professionals. And did you not do that with the information you had? Could be willfully blind. But the real question is, did you report the income? Because you've got to report, everybody knows you got to pay taxes on your income. Some people, say, well, I pay tax in the other country, and that's slightly better. But if you didn't report it somewhere on your US return, it's harder for us to explain away. And then, of course, when you found out there was a problem, what did you do? And how long did it take to do it? That becomes a big, when we're filling those gaps of time, I know it's 6 months extensions are pretty normal in this world, and a year to figure that out. But the IRS scrutinizes each month. And then were there affirmative acts and continuance of the error? That's that Canali type of question where they, did one extra, even though they knew the IRS knew about the accounts, they still filed one more return with the question on it and made it criminal in that case. Oh, and then, were there actions that could be attempt to conceal, moving it to a different account, things like that. So you have to be very careful. So I'll pass it on to Jared, and he can talk a little bit more about the non-formal sort of things.
Yeah, so the first program, so here's the last two programs that are kind of out there for amnesty programs the IRS is put out there. This is very common. It's probably one of the easiest programs to participate in. There's really no penalties. I don't think there's much risk of the IRS coming back as long as you qualify for it. But the other programs were, if you had unreported assets on like FBARs and you had unreported income, that's what the Streamline program's for. That's what that voluntary disclosure program is for. This one on the delinquent FBAR filing procedures, this is mainly for one that you don't qualify for that because you don't have unreported income. There's other requirements. You can't be under civil examination or criminal investigation with the IRS regarding not reporting foreign bank accounts, but there's no penalty associated with it. It's been out there for a while now, and it's a great program, but you can't have any unreported income. So if you reported the income, you just didn't file the FBAR, this is the program for you. Next one, this one's kind of changed recently, the way that the IRS is communicating it. I don't know if it's really changed that much, but it's got a lot of the attorneys and some of the wording that the IRS has on their website, the way they're treating this now, has a lot of attorneys and accountants nervous about what they're doing. So the delinquent international informational return procedures, it's basically for someone that they've never filed a 3520, 3520A, 5471, or one of these forms on this screen. They're not under civil examination or criminal investigation with the IRS, but they've reported income from those assets from their 3520s and 3520As. So the issue is they have reasonable cause for not filing these forms, but they didn't file them, but they reported the income. So what do? Well, this is what this program is out there to do. And where this has changed is the IRS is now publishing on their website that when you file this under this procedure, you may want to include a reasonable cause statement. It's not required, but you may want to do it. Eventually, and then they say even if you submit the reasonable cause statement with the filing of these forms, we may assess a penalty regardless. Meaning, well, if you file under this form with a reasonable cause statement and they assess a $10,000 penalty for failure to file 5471, well, now you're kind of in this, you have to pay the balance due and argue through like appeals to get out of it, or a first-time abatement request, or abatement of penalty request, and so what's happening now is also now you're having to argue your reasonable cause with an IRS agent, whereas before you would just file it, you just send it in, and a lot of times we would never hear from the IRS regarding this procedure. Well, now the IRS is saying, well, we might assess this penalty, and now you have to argue this through appeals or some other means to get the penalty removed.
But it's still a good exercise to prepare the reasonable cause statement on the filing, and then be ready for it. So
that's what we generally do.
Even though it's frustrating, they don't respond. But.
Yep. And that's what we generally do is we'll prepare the reasonable cause statement, send it in. If they assess a penalty, we'll resend it in, ask for an abatement request. A lot of times they don't, so then we have to go to appeals to get out of the penalty. And as many people know nowadays, dealing with the IRS is just as takes so much time now. They're so far behind with all these things. So it's a matter of time and whether you can stomach getting some of these penalties and notices, and so it's troublesome or I guess it feels troublesome for a lot of individuals that run into this. But yeah, we appreciate you guys listening, and this is kind of it can be kind of complicated. We're here to help you kind of navigate through these rules and laws. So please reach out if you guys have questions.
Yeah, and we just can't understate the importance of analyzing it first, figuring out where to go, and being delicate with the facts there. I mean, I would, even in the one where you just feel clearly you're not at fault, you don't just go in and talk to the agent. Anything you ever do in a tax return or talk to the IRS, this one is the most iffy area.
Yeah.
And don't take advice from your best friend too.
Oh, I've seen that come back to bite some people too. Anyways, yeah.
Got one question. Is Form 8865 required if a partnership is building a property but hasn't rented or received income yet?
Well, the filing requirements of Form 8865 are pretty complicated, whether or not you have that filing obligation. So what was let me read the question again.
It says if they're building the property, but they haven't received any income, haven't rented it. So they're just expending funds there.
Yeah, you would, if you meet the filing requirements to file Form 8865, and this is your fact, yes, you would have to file and report those expenses. So a lot of times, especially in the year which you acquire the partnership interest. So that very first year you acquire it, and I'm assuming this is probably a first year, that's generally the year where you do definitely have a filing obligation in most situations. So, so I would, yeah, most situations, yes, you would in that.
And Deegan just responded. She said, yes, cost of
building the asset. Yeah. So in most situations, and you would need to file that.